Good morning, and thank you for taking the time out and speaking with us. What would your initial reaction be on the news flow?
Well, we thought there was a more than 50% chance of A-shares joining the MSCI index. I think the consensus was sort of probably 50-50, so a little bit less optimistic than our view. It is now going ahead. Obviously, implementation is taking place in two phases, May next year and August next year, and the total size of weight in the EM index is not that large at around 70 basis points. So we thought it would have an incrementally positive impact on the market today, which is what we're seeing. The A-share indices are up. The CSI 300 about 70 basis points when, as you were just mentioning, global equities are down. So it's an incremental positive and an important milestone for the A-share markets, but it's not sort of transformational in terms of near-term market performance.
Okay. Jonathan, good morning. Thanks for joining and making this unscheduled stop with us. Two more numbers, if you can help us with. When you say Asia gets a 70 basis point leg up in global indices, how much money are we talking about, given the current passive funds who follow the MSCI indices? How much more money comes to Asia? And the more important, within Asia, if the rebalancing gives more weight to Chinese A-shares, Indian weightage apparently comes down from 8.9 to 8.8. Will that mean money pulled out of India?
Yeah, I don't think it has any great implications for India. So within both the MSCI Asia Pacific ex Japan and EM index, the weighting pro forma a year from now, a year to 18 months from now, will be 70 basis points. So in terms of money flows, for purely passive ETF money, it amounts to maybe $2 to $4 billion, depending on how much active money already owns A-shares, which you can do through the QFII quota or the Connect programs. MSCI has estimated maybe another sort of $12 to $15 billion. But it's not money that is likely incrementally moved from India, because the actual weight of EM within the All-Country World Index will also rise when A-shares are included. Okay. So it's additive. It's not substituting for money that's currently in the Indian market.
Oh, okay. So what did you mean by that $3 to $4 billion?
Passive money, so ETF money, which is not actively managed, which is stuff money that has zero exposure because it's not currently in the index now, and will have to buy May and August next year. But actively managed money is already been buying A-shares through their QFII regime and the Connect program. It's hard to judge exactly where the weighting of active money is, but certainly it's not zero.
Okay, so that's an important clarification, that there might not be any great implication on India and money will not move out of India. In fact, India has been your #1 choice of investments within the Asian basket for a while. Yeah. Does that continue, and what would your outlook be for India over the next 6 months?
Yeah, we continue Constructive, as is my colleague Ridham Desai, who you probably know very well. So we have had very substantial gains, more than 20% US dollar return year to date. I think probably another 5 to 8% could be likely by the end of the year. And really the story is a very strong cyclical pickup in the forecast horizon and a pickup of earnings revisions, particularly for cyclical sectors. And I would say reasonable valuations to EM and to its own history for India, not outstandingly cheap. But it's at a time when some other markets that we are underweight on have significant issues, particularly Australia and South Africa. So the Australian market is performing quite poorly year to date. We expect that to continue. So I do think within the Asia ex Japan universe for our clients, we're advising rotating from a market like Australia towards a market like India.
Okay. Your note also says that MSCI said that it would consult with investors and other market participants on whether to raise the inclusion factor from the current 5% and whether to include A-share mid-cap names as well. When do you think this might come to a head, and will that be a further additional money coming into Asia?
Yeah, so in terms of the inclusion factor, if you look historically at Korea and Taiwan, that's been quite a slow process, 10 years to go towards full inclusion. And they say they'll consult along the way. I think the mid-cap stock being included can happen more quickly, perhaps.
Okay. All right. Will all this be a very big impact, or will it ultimately depend on Chinese growth as well? If the growth didn't oblige, then will this factor not be too important?
Well, we're fundamentally positive on Chinese equities as we are on Indian equities, both onshore and offshore. Actually, we're more advocating the offshore IT-heavy MSCI China index. But the Shanghai Composite should benefit from 2 years of decent earnings growth this year and next, having had negative year-on-year earnings growth prior 2 years. And valuations are certainly reasonable. They're well below long-run average levels. So our Shanghai Composite target is 3,700, and the index is trading right now at about 3,150. So that gives mid-teens upside.
Okay, so you spoke about how you're positive on China. You continue to be positive on India. So overall, for the emerging market index, Jonathan, what would your prognosis be? Will the MSCI decision to include A shares help reduce market fluctuation and perhaps even increase FII participation over the next, say, 6 to 12 months within the EM basket itself?
Well, the broad EM index, particularly the EMEA and Latin America component, is somewhat challenged by the current performance of the oil price and the and commodity prices more broadly. So, in fact, we are underweight EM broadly, but trying to pick our spots in markets like China and India.
Okay.
And we are within about 3% of our EM target price. Which is 1050, the MSCI EM index. So actually we have more upside target in markets like the S&P and Japan, and indeed China and India than we do in the broad EM index here.
So you're saying that between developed and emerging markets, you see a higher potential of developed markets outperforming for the rest of 2017?
Yes, that's right.
Okay. Jonathan, a final question. What might this do to the yuan? A year ago, there were still worries about yuan devaluation, but in the last few months, we've seen a strong appreciation. Will this be a boost for the yuan and see it stronger?
Well, we think it ends the year at about 7.0 to the dollar, so slightly weaker than where it is now. And that's due more with global dollar strength than yuan weakness in our forecast horizon. Remember that the Connect program, which is what's used for the A-share trading, is the CNH market, the offshore market, so not the official CNY market.
Okay.
So that forecast that I gave you is for the CNY market, and there's no implication from A-share inclusion for the renminbi, the CNY.
All right. We'll leave it at that, Jonathan Garner. Thank you very much for joining us and explaining